Your CPA isn't holding out on you, neither is your attorney. They're each doing their job, and that's exactly the problem. If you're a physician, attorney, dentist, consultant, or running a service business with a small team, there's a good chance your tax plan still has gaps. Not because anyone made a mistake, but because no one is sitting in the middle looking at how it all works together. In 28 years of working with business owners, there are 7 strategies I bring up in almost every conversation that most owners have never even discussed. And stay with me for strategy 6. It's one that almost everyone is either missing entirely or doing it in a way that creates more risk than it solves. By the end of this, you'll have a 7-question checklist you can use right away. If you're new here, I'm John. This channel is built specifically for professional service owners because the planning you need is different. A few years ago, I was in Costa Rica talking with a bookkeeper for $1 million practice. She pointed out gaps in my own financial picture I hadn't seen. Today, I'm going to walk you through 7 strategies I now raise in almost every client conversation. And just a quick note, examples here are hypothetical and for illustration purposes only. If something applies to you, talk with your CPA or your advisor before you take any action. Let's get into it. HRAs. I ask almost every business owner, how are you handling family medical expenses? Most are paying everything personally, deductibles, dental, vision, with after-tax dollars. No one has ever showed them another way. Let's take a physician spending around $18,000 a year out of pocket. When I ask if the business reimburses that, the answer is almost always no. Now, there are structures like QSE-HRA and ICHRA, and depending on your setup, your advisor and your CPA can help coordinate this. The reason why this gets missed, people assume that their health plan already handles it, or that it's complicated, and it's not. It's a simple plan document. So pull last year's medical expenses and see if this structure fits in your situation. You're probably already spending the money. The question is whether the business is getting credit for it. And the HRA, it's just the first layer. The next strategy is one most owners think they've already maxed out, but they haven't. Section 162 executive bonuses. A lot of owners I meet are already maxing their 401ks, and that's where the conversation stops. The next layer almost never comes up. A Section 162 executive bonus plan allows the business to pay a deductible bonus, which is then used to fund the permanent life insurance policy. The cash value grows tax deferred, and you can have access to that money later through policy loans depending on how it's structured. One important caveat, if the policy lapses with outstanding loans, those amounts become taxable income. That's why the design and the ongoing monitoring matter as much as the initial setup. This type of policy also provides death benefit protection. The key, this isn't a set it and forget it situation. Design and monitoring do matter. This works best for owners already maxing qualified plans and looking for what's next. The reason why it's missed, it requires a coordination between planning and insurance, and most advisors don't operate in both. If you've maxed your retirement plans, this is a conversation worth having. Maximizing your 401k isn't just the finish line. For most owners at this level, it's the starting point. The next one is all about timing. What happens when you can move income out of your highest earning years entirely? Non-qualified deferred compensation. Most business owners are in their peak earning years right now, and the planning typically stays focused on this year. The question that rarely ever gets asked is, what if you shifted some of today's income into lower income tax years? Non-qualified deferred compensation allows you to defer income into the future, potentially into retirement or post-sale years when your tax rate is going to be lower. There are no contribution limits like a 401k, but here is the trade-off. This is not ERISA protected. It's tied to the business. That risk needs to be understood. And the key is timing. Deferrals must be elected before income is earned. If you have a timeline to step back or exit, this strategy depends on planning early, not at year end. And if you're wondering how this applies to you, this is one worth talking through. Most tax planning isn't about this year. This strategy is about which year, and that's a different conversation entirely. Look, if this is starting to click and you're thinking through your own situation, there's a link below to set up a quick 20-minute chat. Let's get back into it. Spousal IRA. In most business owner households, one spouse runs the business and the other may not have earned income at all. And most assume the spouse can't contribute to a retirement, and that's wrong. A spousal IRA allows contributions based on the working spouse's income. I've seen this missed for years, and those contributions aren't recoverable. It's simple. One account, one contribution per year, and almost always overlooked because no one is looking at the full household picture. The next one, most people already have, they're just using it the wrong way. Chapter 5, HSA. Most people are treating HSA like a spending account, and that's a mistake. It's the only account with triple tax advantage, deductible contributions, tax-free growth, and tax-free withdrawals for medical expenses. What most people don't realize is that you don't have to use it right away. You can invest it, let it grow, and reimburse yourself years later. Pay expenses out of pocket today. Keep your receipts. Use the HSA later as a tax-free income. At age 65, it can even function like a traditional IRA if needed. The reason this gets missed, it's framed as a medical account, not as a long-term wealth tool. If you have an HSA, the question is it being invested or just spent? The HSA isn't just a medical expense account. It's a long-term investment vehicle, one where withdrawals for qualified medical expenses are tax-free and the growth compounds without annual tax drag. Strategy 6, hiring your kids. If you have kids and a business, this one comes up a lot and almost no one is doing it correctly. When structured properly, it does three things. It reduces your tax bill, it shifts income to lower tax bracket, and it creates earned income for the child. That earned income allows them to fund a Roth IRA with the potential for decades of tax advantage growth depending on contribution, timing, and how the account is managed. The rules matter. Real work, fair pay, proper documentation, and the structure matters depending on the entity type. The reason why this gets missed, people think it's complicated or they do it wrong and create risk. Done correctly, this is one of the most powerful long-term strategies on the list. The last one, and this is a strategy that tends to hit hardest for anyone with a business partner because it's what happens when something goes wrong. Buy-sell agreements. Most practices with partners have a buy-sell agreement and almost none have reviewed it recently. And that's where problems show up. There are two key risks. Funding hasn't kept up with the valuation and disability provisions aren't properly addressed. I've seen situations where the business grew, but the insurance funding didn't, leaving a major gap. Or worse, a partner becomes disabled and there's no clear way to handle this. The structure matters, entity versus cross-purchase, and so does ongoing reviews. If you have a buy-sell agreement, ask, is it funded? Is it current? Does it cover disability? And if you're not sure, that's an issue. A buy-sell agreement that hasn't been reviewed isn't protection. It's a document that gives people false confidence. These strategies, they live in the gap between your CPA, your attorney, and your advisor. The gap is where I work. At TriBox, we focus on three things: cash flow, protection, and investments. We coordinate those pieces so decisions are made from a full picture, not in isolation. That's the role. Now, before I let you go, here's a checklist I promised you. Take a screenshot of this. And if this sparked questions or feels confusing and you're wondering how it might apply to you and you want to walk through your situation, there's a link below to set up a quick chat. I'm happy to help you get clarity. And there's been some changes to tax laws that most people aren't taking advantage of. Check out the video I recorded to help you gain an understanding of what you could be doing right now. Thanks for watching. I'll see you on the next one.